Hi there. This is Bob Graham with Riggs Asset Management Company. It's the first week of 2026, and I thought we might just do, sort of an overview of what we see going forward. And as the year goes by, we'll provide more detail, but just give a sense of what we see in the markets coming forward for this year, whether it's in the equity markets or in the fixed income markets. To kind of jump to the punchline, we think it's going to be a decent year. We think the equity markets should work out and have another positive year. So it'll be the fourth good year in a row for the equity markets. And we think the fixed income markets are going to be pretty good too. I mean, not as good as the equity, but you wouldn't expect that. But so I think if you're a fixed income investor or if you're an equity investor, you can look at, 2026 and say, hey, expectations are for a decent year going forward. Now, it may be a bumpy year, and we'll talk about that as we move forward, but it will be a good year. So let's talk about the backdrop. We have some long-term themes that, whether it's the build-out of AI or, the build-out that goes with AI, the electrical grid, and all those things, we're going to continue to see those things expand and are going to be very, very good. On the fixed income side, same thing. We're in a relatively steady, slow easing cycle by the Federal Reserve, and that should help the bond market and the economy as we move forward. But we're in a midterm election year, and midterm election years tend to be bumpy, especially as we get closer to the election. And we'll talk about how that may affect the markets. So why don't we switch over? We'll just talk briefly about what's going on in the bond market, the economy, and how that could affect your portfolios. So when we look at the bond market, just let me flip through here for 1 second. There are really two competing pressures on the market. One is what's going on the employment side. So if you think about it, employment demand or hiring in the United States peaked in roughly in 2021. And ever since then has just gradually been coming down. And we've seen that consistently. And right now, if you look at, employment, it's, there's some demand out there, but it's not like what it was. A couple of reasons for that. Part of it is that a lot of companies hired more people than they needed because they weren't sure what was going to happen coming out of COVID. And over time, they've basically allowed excess employment to work off. And the other thing is we may be beginning to see the early stages of the use of artificial intelligence. We've certainly seen that in the technology space. We may see that continue through other areas of the economy as we move forward in this year. The counter to that is what we're seeing with commodities. So, if we look at specifically metals, whether it's copper, tin, aluminum, rare earths, whatever they may be, the build out of a technological, heavy industrial economy requires stuff. And a lot of that stuff is very specialized. So we're seeing the cost of metals, particularly, on the rise. So those two things are somewhat offsetting, but overall, our expectation is that the economy should stay relatively strong. Employment, we think, will kind of bump along and may improve a little bit as we move forward, but there's not going to be a lot of pressure on the Federal Reserve or anyone, to think about higher interest rates down the road. And in fact, when we look at our primary indicator, the 2-year Treasury, it tells us that we should see 1 to 2 interest rate cuts this year, which should help benefit the bond market and help benefit the economy. So overall, for fixed income investors, if you look at a 10-year Treasury yielding about 4.1, 4.15% today, expectations are you'll make your coupon and maybe a little bit more as interest rates come down. The key here is to be, it's going to sound a little wonky, but position correctly in the bond market or position correctly along the curve. And right now, your portfolios are actually designed and positioned to take advantage of this slow decline in short-term interest rates and an economy that does, quite frankly, pretty well. So, right now I think we're set pretty well for this backdrop in the fixed income markets. Switching to the equity side, we said it's going to be a bumpy year, kind of what we've seen in the last couple of years. The big difference this year is we are now in a midterm election year cycle. And like all election years, you tend to get a little bit more volatility. As you get closer to the election, people have very, very strong opinions, and you tend to see that reflect itself not only in the headlines of news, but sometimes in the market. So if you think about a typical midterm election year, typically have a fairly strong first part of the year. Typically January, February tends to be decent. As you get into early summer, you may peak around there, or late fall. Then as you get closer to the election, the markets become under pressure. And we could see a pullback this year of maybe 10%, 15%, maybe a little bit more. I mean, we certainly saw that last year. So this year, I would not be surprised to see something like that. But interestingly enough, when you look at the long-term statistics, second term president, midterm election year, the average return is about 8.8%. And when you look at what Wall Street is doing, the large banks that all make predictions about where the market's going to be, a year from today at the end of this year, they're all in about that range. You see the high end of some people expecting as high as 14%, the low end, some people thinking around 3%. I think we're probably going to come into a year that's probably in the high single digits, low double digits, which is kind of with historical averages. The key is, where are you allocated? So there's a transition coming this year. So we think it's going to be a bumpy, just like we've seen last year. 2 steps forward, 1 step back, 2 steps forward. But the key is, we're seeing a transition in the markets where last year and really the year before, it was all about the artificial intelligence build out and how that was driving, whether that was demand for steel, whether it was demand for copper, whether that was demand for chips, who's going to build, how many chips would you need, and all the stuff that goes in that. Well, we think that continues. But interestingly enough, we're seeing the transition where companies today are actually implementing the technology. In fact, it's the fastest pickup, the fastest implementation of a technological advance that we've ever seen in history. And the reason being is because the road system, the backbone, was already in place. AI runs on the internet, and we've spent the last 30 years building that out. So the infrastructure is already in place to adopt this technology. So when we look out, we see whether it's a mining company, whether it's a financial company, whether it's a company involved in trucking or transportation, we're seeing the pickup and use of AI. And I think in 2026, we're going to see that pickup, that use of AI, drop to those companies' bottom line. So what does it mean? It means you're going to see, I think, an economy that does pretty well, driven by AI, but driven by AI throughout the entire structure of the U.S. economy. So you could see a pickup in earnings and margins in financials, a pickup in earning margins in transportation trucking companies, a pickup in earning and margin in energy exploration or mining companies as it builds out. So yes, driven by many of the same things we've had over the last couple of years, but now the implications are it's spreading out to the larger economy. So we think it's going to be a really interesting year. We think it's going to be a really good year or a good year for fixed income investors, a good year for equity investors, choppy, but good. And the key is going to be identifying and moving the portfolios to those industries, not that are necessarily building out the AI. I think that's still a good play, but those industries that are benefiting from it. And we'll talk more about that later, but that's what your portfolio management team is doing today. You can see that reflected in your portfolios, and we look forward to a bumpy but really good 2026. Thank you.